Okay, the first thing I just need to do is because I took a screenshot that's actually easier, so you can see where the initial setup was, other than obviously looking at the CSI, but looking at the chart. This is the Euro Canadian that I took. Can't remember, about half an hour ago, wasn't it, David? Yeah. But basically, this is the 3-minute chart. And we can see here, this is the volume point of control. The volume point of control is, it has its it's got a little bit of what we call market profile in it. And this area, when a market is in this sort of congestion phase, it's also sometimes known as a value area, which is basically where the market is in balance, in the sense that there's no clear divergence, there's no clear direction, because buying and selling is going on, and it's really not, it's in status, if you like, it's in balance. And markets spend an awful lot of time in balance. In fact, I think they spend 60 or 70% of the time just sort of moving sideways. You then need a trigger to be able to move that price in one direction. Sometimes it'll be a piece of fundamental news. Sometimes it'll be a geopolitical event. There are all sorts of catalysts that will move it. From a technical perspective, what you actually need is you need market orders to come in. You need traders to come in, and for whatever reason say, right, I'm going to push that market to either one way or another, because the market, particularly the forex market, is absolutely littered with limit orders, with orders, bank orders. Banks have an obligation. That's the whole reason of their business. They're there to buy and sell currencies for their clients. So the bank traders will say, okay, well, we've got this deal coming in, we've got to buy 10 billion euros or $20 billion or whatever it is. And they will look at a chart, and the first thing they do is they agree with their client that they will affect the transaction for them. It's a simple, put it this way, it's a very, very scaled up version of you going into a bureau de change and saying, I need some money for my holidays. They will quote you a rate, okay? And you don't have any choice. They say you either take it or leave it, or you go to another bureau de change. That's what big corporations do. They go to their bank and they say, we're buying some stuff from China, we're buying stuff, some new piece of machinery. It's all sorts of reasons. They need the banks to effect the exchanges. The bank will quote the exchange, but the bank, what they also do, they charge their clients commission, but they will then go and try and make some money on that. So they look at the chart and they say, okay, well, we've quoted our client this rate, but if we actually push it away, we can make some money on the deal. There's all sorts of things going on. We kind of know what the levels that the banks are interested in two ways. There's something called the order boards, which are difficult to get hold of now. We used to be able to get them quite freely, but you have to subscribe to Reuters. But there is another set of levels that we look at, and that is called the option expiries. And those you will find these at places like Talking Forex, and I think Forex Live also give them as well. So on a daily basis, there are these levels that the banks, they're out there, and price. There's all sorts of reasons. So these are the limit orders. Now, in the meantime, between the orders, obviously the price has got to get there, and they do that in two ways. Market orders come in. An order comes in at an institutional level. I've got to do this exchange. I haven't got time to set up a complicated order, a limit order. So that floods the market with liquidity. Retail traders also provide the liquidity. They will look at their charts from a technical perspective, and they'll say, oh, right, I think there's that Fibonacci level's coming up. I think I'm going to sell, or I'm going to buy it. That provides, and that helps to shift the market out of this this congestion phase that we see here. The congestion phase like this also corresponds to Richard Wyckoff's second law of cause and effect, which basically says the longer a market or price action is in congestion, that is the cause, when it breaks away, the bigger will be the effect. And we can see, this is only a 3-minute chart, but we can see how long this congestion phase lasted on this 3-minute chart. But it's also, it's got the VPOC, but it also has this very strong resistance level here, which is stronger than the blue. That's resistance, that's the blue level is, we sort of call support. And so if you like, it's already got a slightly sort of bearish tone to it. And what then happened, there was a trigger. Maybe it was the oil price, maybe it was, but leaving that aside for the time being, we know that was the beginning of this waterfall lower. And the way I use a chart setup like this, a time chart, I then also have a non-time based chart, which is the Renko chart. Now, this is from NinjaTrader, this 3-minute chart, and my Renko chart is actually from my MT5 platform. This is the level, this here, this zone here, this break here, this is 54.98. This is where the VPOC and that zone there was at the time when I looked at this particular chart. If I just close that for a second, there we are. So that was the break lower. It was in a kind of bearish tone to it because of the resistance that was ahead. But it was the break from there. This move down to here doesn't look very much, but it's actually 70 pips. And this is what has actually happened this morning. Now, the reason I showed you that that screenshot is because in the move lower, this is now the 3-minute chart. This is where it was, back up here, and this is now where it's moved, because this is the move that we had. We can see that we see the waterfall. There's a lot of volatility. We had 2 volatility candles. Then we had another volatility candle on an effort to rise with a reasonable amount of volume underneath it. But as always with volatility, price actually went back into the spread of the candle. Then we had the fall lower. We can see this supported by rising volume. This is now then the VPOC drop down here. So if you like, it was coming into a sort of what we call an accumulation again, a congestion phase again. We had effort to rise. We had a ton of volume going into that candle. We look at the range of that candle with the amount of volume that was underneath it, but it didn't move very far. Then we had another candle with a wick to the top of the candle. It kind of moved side. There's a lot of volume coming in under here, but not a lot is happening, which is what we want to see. And then as I said, we are approaching the London Open when all sorts of things happen. Not so much in cross pairs, but we can see here there's a lot of transactions going on in this phase that is now congestion again. So we had the breakaway. We have the trend, a volatile trend, because we've got the volatility indicator triggered. And this, by the way, everything we say in these sessions is all explained in very great detail in our education program. I know we've got some of our education students here today. They will, what I'm saying will, they will understand clearly what I'm talking about. This is a trend. It was a volatile, then it was much smoother. Now we're going into a congestion phase. There's a lot of volume going into this congestion. We've got a 2-bar reversal, volume underneath it, but the volume then falls away quite quickly. So it's really can't decide what is it going to go higher, is it going to break higher, or is it going to congest for a little while longer. This is where we then have to look at multiple time frames. So this is a 3-minute chart. What am I seeing on my 6-minute chart? Well, I can see the same thing here. It's still attempting to find a base, attempting to find an area of accumulation before it can move higher. Or is it actually just going to go further into congestion and then break lower? And again, what we do, we go and have a look at the slower time frames. This is the 30-minute chart. This is actually what we had this morning with this break, right going back to 4 o'clock in the morning in the Asia session. A big volatility candle. After volatility, we expect a retrace into the spread of the candle. That candle there represents what happened here on this congestion phase. So when you use multiple time frames and you're in a trade and you have something like the 30-minute chart and you see a volatility candle appear suddenly like that, you know almost instantly there is going to be a pause. So you can actually use that as an exit signal. If you want to stay in the trade, that is up to you. Or if you have a number of contracts, you can take something off and just leave it. So what you do is you scale out of the position that you are in. Now, what's interesting on the 30-minute is we've had this effort to rise here, a reasonable amount of volume underneath it. Then we had another down candle. Again, a reasonable amount of volume. But this is the candle which is the most interesting, because as it's being formed at the moment, it has a very deep wick to the top of the candle. But, you know, we're coming, what have we got? Another 8 minutes to go. That doesn't look terribly strong at the moment. If you wanted, you know, if you were either looking for a re-entry, or if you were in a position and you'd left some of the contracts on the table, you would say, okay, well, I just might as well leave them on. And then going up to the daily chart, just for context, what is interesting about the daily chart is this pair has been in this very extended congestion rate, very wide range, I accept that, but it's never really broken into a strong trend one way or the other. What's interesting though is this candle here. This is the sell that we've had overnight and coming into London, and it still looks quite weak. So you could argue that, you know, wait until the setup. If you are on the faster time frames, if we go back to the here, we go back to the Renko chart. This is the move that we've had this morning. This is the congestion that we're seeing at the moment, but it's very, very choppy, as you can see here. So really it's a case of waiting. This is where support and resistance comes in. Well, what are the levels? The levels are here. You really have to wait to 54.23. The beauty of having the indicators that we have developed, if I just bring it up here for a second, is the multiple time frame CSIs will tell you whether, you know, you are going to get a reversal, whether it's going to be a tradable reversal. Now, is that reversal going to be what we call a reversal from primary trend to back to primary, or is it just primary to secondary? And this is where volume price analysis comes in. And Wyckoff's three laws, they give you, they help you with your timing, but they also tell you what is likely to be happening next. So I can see the Canadian has turned down. The euro still hasn't turned back up. This is the 15-minute chart, but you know, you just move. I usually have these on. I usually have 4 or 5 of these up, as David has over there. And you can see the flows into these currencies, and they will both help you with a potential entry, but also help you to keep you in and ride out whether what you're seeing at the moment is just a secondary pullback, or is it the start of a major reversal. This is how this market moves. You all come to it at different times of the trading session. And if you don't look at the multiple time frames, you don't understand what the price structure of the chart that you are looking to trade in, take a trade on, and the price structure of a chart either side of that in terms of time frames, then you know, I think you're going to struggle by sticking to one chart and, you know, just thinking, well, I think it's going to go up, or I think it's going to go down. That's what Wyckoff does. That's what VPA does, and that's what our indicators do. They not only tell you what the narrative of what's going on in the market and on the charts, but more importantly is they tell you what is then likely to happen next. Is there anything you want to add to that, David? That's it. Shall I move over to you now? Yeah, okay.